Imagine you bought silver in August of 2025. You didn't just make money. You made a decision that turned every single dollar you put in into $3.30. A 230% return. In 5 months. That kind of return doesn't just feel good. It feels inevitable. It feels like you finally cracked the code. Like the market, for once, is on your side. And that feeling is exactly when the market takes everything back. Welcome to Schooled by Market. I'm going to show you today why silver has, in all likelihood, already put in its top. Why the charts, the history, and 60 years of data are all pointing to the same uncomfortable conclusion. And I'm going to show you what gold is doing, because the story of these two metals is not the same story. Not even close. Stay with me. This one is important. Let's start with the basics. Because before we get into the charts, you need to understand what we're actually dealing with when we talk about gold and silver as investments. On the surface, they look like cousins. Both are precious metals. Both have been used as stores of value for literally thousands of years. Both have deep, liquid markets where billions of dollars trade hands every single day. And in recent months, both became the absolute darlings of retail traders. The kind of assets that show up in social media feeds, Reddit threads, and late-night YouTube rabbit holes. But here's where I need you to pay close attention. Because underneath the surface, gold and silver are fundamentally different animals. Gold behaves like a conservative macro hedge. It's the asset you buy when you're worried about inflation, geopolitical instability, or the slow erosion of purchasing power over decades. It moves deliberately. Institutions hold it. Central banks hold it. It is, for lack of a better word, boring. And that is a feature, not a bug. Silver? Silver is something else entirely. Silver is smaller. Silver is wilder. Silver has significant industrial demand. It goes into solar panels, electronics, medical equipment. It responds to economic cycles in ways that gold simply doesn't. It has what traders call higher beta, which means when it moves hard in both directions. And that's precisely what makes silver so seductive to retail traders. And so dangerous. Between August 2025 and January 2026, silver ran up 230%. Over the same period, gold rose by 71%. Both are extraordinary numbers, but silver's move was in a completely different league. And when something moves 230% in 5 months, the question you need to be asking is not, how high can it go? The question you need to be asking is, what happens when it stops? Let's look at silver on the daily time frame. This is the chart of what's been happening in recent weeks and months. Here is the top. Right there. Beautiful, parabolic, almost vertical price action. This is what 230% in 5 months looks like on a chart. It doesn't look like a healthy trend. It looks like a rocket. Now look below the price at the RSI, the Relative Strength Index. While price was making a new high, the RSI was making a lower high. That's called a bearish divergence, and it's one of the oldest warning signals in technical analysis. It means that beneath the surface, the momentum that was driving price higher was already starting to fade, even while price itself hadn't yet turned. And since that top, price has corrected almost 50%. Let that sink in. If you bought silver anywhere near its peak, you have lost half your money. Now, price has found some temporary support around the 150-day simple moving average. And yes, that's a meaningful level. But here's why I'm not ready to call this the bottom. Look at the stochastic RSI. It is firmly in bearish territory. There's no sign of a reversal yet. And the regular RSI? It hasn't reached oversold levels. It hasn't hit the kind of exhaustion level that typically marks a real floor, which means there is very likely more downside ahead. The next major support sits around the 200-day simple moving average. approximately $57 per ounce as of the time of this video. That's the level to watch. But here's the thing. The daily chart is just the beginning of the story. The real story, it lives on the quarterly chart, and it goes back 60 years. When traders lose money, it's usually because they're looking at the wrong time frame. They see the daily candles, maybe the weekly. They're focused on what happened yesterday and what might happen tomorrow. And they completely miss the macro picture. The picture that tells you with uncomfortable clarity where you actually are in the cycle. This is the silver quarterly chart. Every single candle you see here represents 3 months of price action. And this chart stretches back 60 years. Take a moment. Let your eyes adjust to this scale. Now look at the RSI below. There is a line drawn at the 85 level. That's an extreme reading. And in 60 years of silver price history, the RSI has only crossed above 85, and then reversed 4 times. 4 times. In 60 years. And every single time, without exception, what followed was a significant, prolonged decline. We are currently witnessing the 5th such occurrence. The market is teaching now, but are you listening? And below the RSI, we have the stochastic RSI, which is already showing a bearish crossover. This is the second confirmation signal. When both the RSI and the stochastic RSI are singing the same tune, you pay attention. Let's now walk through each of those 4 historical moments. Because the past doesn't repeat, but it rhymes. And what it's rhyming right now should make every silver holder very, very uncomfortable. The year is 1968. The world is in turmoil. Political assassinations. The Vietnam War escalating. Social upheaval across the Western world. And silver? Silver is flying. By the second quarter of 1968, silver had reached a price of $2.50 per ounce. But the stochastic RSI was already sounding the alarm. A bearish crossover had already printed. The smart money was already reading the warning signs. Then in Q3, the RSI broke below 85. And what followed was a 3.5-year bear market. Price collapsed from $2.50 all the way down to $1.29. That is a 48% correction. 48%. From the top, silver eventually found its floor at the 50-period simple moving average. And only then, after years of pain, did the recovery begin. Fast forward to 1974. The oil crisis has rattled global markets. Inflation is raging. And once again, silver is running. By Q1 of 1974, silver hit a record high of $6.70 per ounce. A new all-time high. And once again, the RSI crossed back below 85 in Q2. The stochastic RSI flashed a bearish crossover. The same warning. The same signals. Price fell 43% from its top. But this time, the aftermath looked slightly different. Instead of a prolonged bear market, silver entered a period of consolidation. A long, grinding sideways churn that lasted almost 4 years. Now, if you're a silver holder today, this is actually the optimistic scenario. For years of going nowhere is painful, but it's far better than what came next in our history. Now we arrive at the one that keeps precious metals traders up at night. 1980. Between 1976 and 1980, silver went from $3.80 per ounce to $48. That is a 12 times return. In 4 years, the Hunt brothers were cornering the market. Silver was on the front page of every financial newspaper in the world. The FOMO was deafening, and silver holders felt invincible. This is precisely when the market collapses. The RSI broke below 85. The stochastic RSI crossed bearish. And then, one of the most devastating collapses in commodity history began. A 92% decline. over 13 years. Let me say that again. 92%. 13 years. If you bought at the top in 1980, you would not have broken even, in real terms, for the better part of 2 decades. Recovery only began after silver found support at the 200-period simple moving average. A long, lonely road back. And then there's 2011, the post-financial crisis era. Quantitative easing is flowing. Gold and silver are the assets of the decade. And silver, once again, is printing history. 9 consecutive quarters of green candles. 9. Every single quarter for more than 2 years. Higher. A 5 times return in just over 24 months. Silver buyers were, once again, feeling invincible. In Q2 of 2011, the RSI crossed back below 85. The first alarm bell. The stochastic RSI held for 1 more quarter, giving latecomers one final chance to act. Then in Q3, it too made a bearish crossover. What followed was nearly 9 years of bear market. A maximum drawdown of 76% from the top. Not weeks, not months, 9 years. Price eventually found its floor at the 100-period simple moving average. And the cycle, slowly, began again. Now, back to today. Back to right now, the end of Q1 2026. 9 solid quarterly candles of appreciation. Silver went from a low of $20 per ounce all the way to $120. A 6 times return in 27 months. Sound familiar? The RSI has crossed above 85 and is reversing. The stochastic RSI has already made its bearish crossover. Price has already corrected almost 50% from the recent peak. In the optimistic scenario, this plays out like 1974, a period of painful consolidation. Silver goes sideways for a few years. Boring but survivable. In the worst-case scenario, this is 1980 or 2011, a prolonged multi-year bear market where silver eventually finds support at one of the long-term moving averages on the quarterly chart. Neither scenario is good news if you bought silver near the recent top. Now let's talk about gold, because this is where the story gets genuinely interesting. Gold has its own 60-year history, and its topping sequence, the pattern that precedes its major peaks, is different from silver's. For gold, the danger zone isn't 85 on the RSI. It's 90, and across 60 years and 4 major tops, gold's RSI has reached above 90 before every single peak. And there's a second condition. Gold tops have historically only occurred after a bearish divergence appears on the RSI, where price makes a new high but RSI makes a lower high. Just like what we saw on silver's daily chart. Now, here's the crucial question. Has gold's RSI broken above 90? No, not quite yet. Not on a quarterly closing basis. And is there a bearish divergence on the RSI? No, there is not. Which means, by its own historical rules, gold has not yet topped. Now here's the relationship that ties it all together. When we overlay the dates when silver topped onto the gold chart, a consistent pattern emerges. Gold has historically always topped after silver. Think about why that makes sense. Traders who are active in silver are often active in gold too. When silver goes parabolic and then collapses, where do you think those profit-taking flows go? They rotate into gold, which is safer, more stable, and historically a better store of value. That rotation gives gold an extra push, a final leg higher, even after silver has already begun its descent. This behavior is likely why gold always has a few extra quarters of runway after silver tops. Why you need bearish divergence to confirm gold's top, but not silver's. So if silver has already topped, and all the evidence suggests it has, then gold's top is likely still ahead of us. Perhaps a few quarters away, perhaps more. That doesn't mean gold is a riskless trade. Nothing in markets is, but the historical framework is clear. Gold and silver do not top together. They never have. Let me bring this all together. Silver ran 230% between August 2025 and January 2026. It was one of the great precious metals moves of the modern era. And now, the quarterly RSI has crossed above 85 and reversed. The stochastic RSI has made a bearish crossover. Price has already corrected 50% from its peak. Every single time this configuration has appeared in silver's 60-year history, in 1968, 1974, 1980, and 2011, what followed was a major, prolonged bear market. The drawdowns ranged from 43% to 92%. The durations ranged from 3 years to 13 years. That is the weight of history sitting on silver's shoulders right now. Gold tells a different story. Its RSI has not broken above 90. There is no bearish divergence. And historically, it tops after silver. Not with silver. This does not mean gold is a guaranteed winner from here. Markets are messy. Exceptions happen. A macro shock, a war, a financial crisis, a black swan could scramble all of this in a matter of days. But what this analysis gives you is context, historical precedent, a framework for understanding where we are in the cycle, and what has happened every single other time the market has looked like this. The market is teaching. Are you listening? If this breakdown was useful to you, hit that like button. It genuinely helps more people find this content. Subscribe to Schooled by Market for more deep dive technical analysis on precious metals, macro markets, and the patterns that repeat across decades. And drop a comment below. I want to know, are you holding silver right now? Have you taken profits? Are you watching gold for its own top? Tell me where you're at. Until next time, the market is always teaching. The only question is whether you're in class.